now is I'm going to move you into the tax laws and kind of how they impact real estate and investments and so forth. Little pre-warning before I teach this to you. Some of the things I'm going to teach you through time so you can see what's progressed over the years in tax law and then bring it current. The very first thing I want to teach you is our government basically looks at all this the same way when it comes to our taxable income. They say all of us in this room have three sources of taxable income, and the first source is what most people have. We call it our active income or ordinary income. And if you look at the name, it really tells you what it is. It's the income that we all derive when we get up in the morning and go out and actively do something to produce income. It's the income we get in the form of our job or our career in the form of wages or commissions. So what I'd like you to jot down, number one, is our active income is in the form of wages and commissions. All right, now, when I teach this to you, I'm going to use this little diagram that I have up here on your whiteboard, and you'll notice that the diagram has the two headings across the top, job and investments, with a line down the middle. I want all of you in your mind right now to visualize the line that I put down the middle there as a wall. It's a wall that Congress has been building for years. They got it completed way back on January 1st, 1987, so it's been around a while. The purpose of the wall is to separate the income that we make when we invest from the income that we make from our job or career. And this will make sense to you in just a minute as I show you how the wall works. But here's what I want to do. In all of my examples this morning, I'm going to give you your first year's income in real estate underneath this active income category. I'm going to say your first year in real estate, what you're going to make is $100,000 a year. Or less. Now, let me tell you why I say $100,000 a year or less. In this country, if you make that $100,000 a year or less, you're considered to be middle class or lower class in this country. If you get above that $100,000 mark, you're considered to be upper class. Or the way I like to say it is, if you're above $100,000, you're rich. If you're less than $100,000, you're not rich. Now, why do I bring this up? Because believe it or not, the tax laws for the not rich are different than the tax laws for the rich. By the way, does that make sense? They have different sets of laws depending on where your income is. Why would they do that? Think. They're the ones who make the laws, and in what category are they at? They're rich. And by the way, I want to make a comment. Is it true that America is a capitalistic society, meaning that the purpose of business is to make a profit? And if the businesses make a profit, it's supposed to affect our whole economy and help everybody. Isn't that true? So therefore, are our laws geared towards helping businesses make profits and making the rich richer? Isn't that true? So therefore, if you don't like this, it tells me a couple things. First of all, if you don't like this, it tells me what level you're at. It also tells me that you need to learn how to get up to that level, because then you'll see that's where it's more advantageous underneath the tax laws. All right, now, here's what I'm going to do. I'm going to teach you the tax laws if you make $100,000 or less first. Then I'm going to show you some of them of how they change when you go above $100,000. And I'm going to assume most of you know this. If I make $100,000 or less, I have certain tax deductions I can take away from that $100,000, reducing my taxable income to a lesser amount. But now, I can also take some of this money and throw it on this side of the wall into investments. When I invest, there are two ways to invest. The first way to invest is to invest in something referred to as portfolio income. Now, before you write down anything, I want to give you the definition. Portfolio income is basically when you invest with a bunch of other people to hopefully produce a profit. Okay, several examples. If I buy stock, isn't it true that I'm buying a piece of a company with a bunch of other people? And if the company does well, I get profits either in the form that the stock goes up in value or the company gives us all what's called a dividend. Isn't that true? That's portfolio income. If I put my money in the bank, do a bunch of other people do the exact same thing? And when they put their money in the bank, isn't it true that the bank pays an interest rate to everybody pretty much the same? That's portfolio income. So what portfolio income is, it's whenever you invest primarily with a bunch of other people, hopefully to produce a profit. And the example I want you to jot down for now is when you make money, stocks, bonds, dividends, interest, those are examples of portfolio income. Okay, now I want to show you something about how this wall theory works. And what I'm going to show you is the rule. Keep in mind, with everything I teach you, are there exceptions to the rule when we deal with IRS rules? Yes, this is just the rule. Watch how this works. Let's say you decide to take $10,000 and invest in portfolio income, which means you chose a stock you wanted to buy for $10,000, okay? And let's say you decide to buy the stock for $10,000 and you're going to hang on to it for a while with the hopes that it goes up or goes down. Now, let's say you're unfortunate though and the value of the stock goes down. You've had it for a while and therefore you're going to sell it. When you sell it, we now say you have a long-term capital loss, meaning you've lost money on this. Okay, well here's the rule. You've now lost $5,000. It used to be, prior to 1987, whenever you lost money in the stock market over a long period of time, that loss was deductible from your job or career over here. But in 1987, they created the wall. And the wall basically says this. If you lose money on this side of the wall, you cannot take it as a deduction against this side of the wall over here, with some exceptions. Okay? But primarily the rule is, lose money, stays on that side of the wall, you can't take a deduction over here. Does this affect you tax-wise? Yes or no? Yes, but now let me show you something kind of magical when they built the wall. They also said this. We realized that people could be invested in the stock market. They could buy something for 10, it could jump to 15,000. They're happy, so they decide to sell. Well, if they decide to sell, they made a positive $5,000. And now here's the magical part about the wall. Since this is a positive number, this automatically, with no exception, bounces over the wall and is added to your income over here. Does this make tax sense? Sure it does. What did they just say? They say if you lose money, too bad. But if you make money, we're glad. They tax you on the profits, but you can't take the losses through the wall, with a couple exceptions. Now, this is portfolio income. We're not going to spend any time on this because this is not a stock market class, but I now want to move you over to the third category.